Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow. I want to welcome you to our quarterly call. And to start it off today, we have one of our Oxbow cartoons, but it's really not. It shows that the Federal Reserve Casino and all the things they've had bid up over the last 10 years because of the free money. Just to get you started on the right foot, so to speak, here. But one of the things we wanted to talk about today are the numerous items that people are asking questions about. If you notice here, one is how bad is inflation? Two, is there any yield? Where could I get some yield on fixed income? Is the stock market too expensive? And what happens in this red hot housing market? We'll try to address some of those things as we go along. So let's talk about the economy first. Obviously, prices are going up no matter what anybody in Washington or the Federal Reserve tells you. I put three things here: soybeans, corn, and lumber, which oddly enough, people want to say, well, we're not up that much, but we really are. If you look at it, we're up anywhere between 50 and 150% on a number of items that were well before COVID, and I'm talking about the last 5 years. So obviously things are going up in price. The other thing that's happening is we're starting to get things backed up in a backlog. You can't order anything, and I know all of you experienced that, but what's happening is business inventories are at a new low. So when you need something, regardless of what it is, equipment, etc., it's taking you a long time to get it, if you can get it at all this year. We're seeing that happen, and then the other thing that's happening, we put this in here, is what we call shrinkflation. Now this is happening in many, many areas, and not just food, but many material goods, many food items. That's where they try to sneak in on you and say, okay, here's what's happening. Same price, but when you start looking at it, it's a little bit lower. This happened to me. I was talking to one of the portfolio managers about a Snickers bar, and I said, 7 or 8 years ago, the Snickers bar was a lot larger than it is today. So we caught on the idea, and this is only a minor list. We have probably 200 items on this list that since 2020, they have actually shrunk the size of all of these items, which in effect is inflation. You're paying the same price for lesser items. So what happens in this inflationary environment? We think there's three possibilities or three outcomes you could have. Obviously, the first one is where the Federal Reserve and Jay Powell is telling you that this whole inflation idea is just transitory. In other words, it's going to last 4 or 5 months, 6 months, and then it all goes back to normal. It sounds good. It really does sound good. Now, whether it happens in reality, different story. We put a maybe on that one. That might happen. It could happen. The second thing that could happen is you have the Federal Reserve thinking it's transitory, but it's not. They realize after getting behind the 8 ball that all of a sudden this inflation is going to keep on going, and they're going to have to do something to control it, which means higher rates. We think that's a maybe too. That could happen. We don't know which one of those would happen. The last thing, which we think is doubtful, is where you go back to a 70s and early 80s style of inflation, and I'm talking about 10, 12, 14, 15%. We don't think that can happen because we have too much debt in this country. We have debt on everything. Every business, every home. We have government debt, 30 trillion. So it's very impossible I wouldn't say it's impossible, but it's improbable that you'll see that happening. So the other thing that happened, I wanted you to be aware of this. The Fed keeps keeping these interest rates lower. We don't understand it at this point. We think that's a mistake. But this is just 1 week's buying of what they're buying in Treasury issues. And what happens with them is they go in and they'll buy, they say we're just buying to keep the short-term rates down. However, if you get into the details every week, they're buying a lot of securities from 8 years to 30 years, which is about 25% of what they're buying total, which is sort of keeping yield curve control in its own way. But if you multiply this times 4, you'll see they're buying $120 billion per month, and they haven't let up yet. The other thing that's happening with all of this cheap money, we think, is that all of a sudden you put in a situation where mortgage rates are really low, And when people buy a home, they do construction to it. It's a natural, whether you buy a small one or a large one. As soon as you buy it, you're probably going to do some things to it. And you notice in here where residential construction spending is going way up, whereas non-residential, a la commercial, that sort of thing, is on the downtick. We think that stays that way until you have a big change in interest rates. So let's see what's happening in the bond market right now. One of the things we mentioned in the letter that we put out in the beginning of the year was this, and that was we expect rates to go up and people in the bond funds to get hurt. They won't expect it, and Wall Street keeps pouring money into them. We just had an article today in the Wall Street Journal about how people are pouring into municipal bond funds, and they're getting about 0.82% all-time low on a 10-year tax-free AAA bond. If you stop and think about that, it doesn't make any sense. And so what happens is all of these bond funds are still down for the year. And we see that continuing until you get a change in something. The other thing I wanted to show you is you hear a lot about negative yields, okay? What that means is, and I've listed up here treasuries, a corporate bond, I've listed tax-frees, but I just took an average of, let's say, 0.76, or it could be 1%. But if you're getting that type of yield, which is what's out there right now, and then all of a sudden you're seeing inflation run at 2.5%, you see that negative 175, that means that you're going backwards every single month. And that's why you've seen us not buy any bonds of any length, I should say, in the last 6 to 8 months. It's been something we decided to do. It's paid off for us. We kept everything short. We think that's been important to us. And we've had to make some other changes. But one of the things that we've had to do in the conservative fixed income accounts, and those accounts are the most conservative strategy we have. But in those strategies, much to our chagrin, unfortunately, the rates on those bonds are very, very low. And what we've had to do to really get those up a little higher is if new money comes in the last 8 to 10 months, they don't have any legacy bonds that are left over from the last 5 years where they're getting 3 or 4%. They have to start anew. What we've had to do in those is go in and take too big to fail banks that pay qualified dividends. What is a qualified dividend? A qualified dividend is the same tax rate as a long-term capital gain. Obviously that may change with the law, but right now it's okay. And you'll see where there's some really good rates on these, and we use that as about a 15 or 20% buffer to push those rates up in those accounts. The other thing we've done, if you remember in 2 strategies, we owned gold, we sold it around 2000. When it came back down to the mid-1700s, we started buying it again. And we've started buying, we don't own as much as we did before, but we will. But one of the things I wanted to show you here is that if you look at this particular graph, and you'll see where gold relative to the blue line, which is the US dollar, it goes up against that currency, and gold relative to all paper money, all currencies, is the red line, and it goes up against those currencies. When you're reflating, when you're inflating, that's what happens over time. So I think you'll find this to be an interesting graph. Goes all the way back to 1920, so it shows you a little bit. Let's talk about what's happening on the stock side. One of the things that you probably don't know is that when the Purchasing Managers Index, that's people that are buying goods for production, when that goes to all-time highs, you're usually getting to a point where the markets and a lot of other things are fully priced. I put this in here where you'll see that right now we've hit a high going back, I guess, some 25, 30 years almost on the Purchasing Managers Index. But if you look at the lower graph, while the index right now is at 64%, if you look at the lower graph, you'll see when that index is over 60, this is a long-term look, when it's over 60, markets don't make much money. They make 1 or 2%, and that's what we're starting to see in the overheating. The other thing I want you to be aware of, and I've said this many times to you, but in the last 20 years, the Federal Reserve has engineered this entire financial setup by offering free money, zero money, and they've really stacked it on top of each other. Every single Federal Reserve president that's come in, or chairman that's come in, has actually stacked their policy on top of the former policy. So now we have this incredibly long period of free money, low money, easy money, and it's caused this, what you're seeing, which is a balloon in financial assets, unfortunately leaving productive assets behind. One of the other things we're noticing, and this comes from what I call recent bias, which is where people have made a lot of money in the stock market or the bond market or the housing market or paintings, everything. Everything's in this category. But what happens is, if you ask them, what do you think I'll make the next 10 years or so, they obviously, 76% of them think, hey, we'll make a lot more money, because that's what's happened to them the last 4 or 5. However, if you look at this particular slide, where the S&P trailing earnings multiple, okay, is the highest we've seen going back to 1990, even higher than it was in 1999, you'll notice that it's going to be a very, very hard climb for them to get those kinds of returns when you start at this level. And we're getting all of these speculative things going on, speculation in bonds, stocks, cryptos. We're getting in real estate, residential real estate. I could name the whole lot to you, but it's gone over into art and baseball cards and you name it. We're getting the whole thing. But let's talk about cryptocurrency, since I mentioned it. You have to look at this chart and wonder about what's going on with people from an investment standpoint. Now, are we saying that there won't be a cryptocurrency or a few that do well and use the blockchain technology? We are. That could very well happen and probably will. But there are 4,000 cryptocurrencies. And everybody that's plugged into a computer and decided, hey, I will make another coin and we'll sell that coin, okay? So when you get 4,000 of those, all of a sudden you'll see in the yellow line, the cryptocurrency value today of all of those is larger than all of the banks that are traded publicly. Now you have to think about that. There's something wrong with that. Obviously, there is a massive speculation going on cryptocurrencies. What happens? In the long run, a number of them will do the same thing that a lot of things happened on the internet in 1998, 99. They're not around. They went to zero. I think the same thing will happen in this area. And like I say, there will be some that survive. But that's what we're looking at this stage. So in the themes that we want to talk about right now, where we'll leave you with today is this. One, if you look at inflation, we think short term it continues. Hard to say what happens after 6 or 8 months. You could fall into a recession or something that changes all of that. We can't say that right now. We can only say where we are right now. In the conservative income accounts, like we mentioned, we've added some 5 to 6% qualified preferred. We think that's a good addition to try to keep those yields up in those accounts. And then you'll notice in our high income accounts, we already own real estate investment trusts, we own preferreds, we own a lot of things. But in addition to that, we picked up a lot of commodities. You'll see we have a large oil or natural gas type allocation. You'll see we own gold, fertilizer, timber. All of those are really fit into the inflation concept. Also in the long-term growth accounts, you'll notice where there are not that many companies today that can truly grow at 15% a year and have good balance sheets, and we can see into the future that what they're selling, what they're producing will work, okay? Chance Finucane, our Chief Investment Officer, has done a great job of screening over the last 3 years where we want to be in these. And you'll see some of the names here that we think are still undervalued due to their growth rate. And you might say, well, they've gone up a lot. Well, they have, but there are not that many companies today that are growing at 15% a year. There are some, but not too many. Some of these are. You'll look also, we have a couple of Chinese companies that are really undervalued. And then our latest 2 holdings, which you'll see are American Tower, one of the largest cell tower companies in the world, and also Taiwan Semiconductor. But what we're looking for is are companies that can do that, can really put that growth piece on. And last, we're running, depending on the strategy, probably somewhere between 25 and 35% liquidity. And you say, well, why would you do that for? Well, a couple of reasons. One, we don't have anything to buy. And let me ask you this question. Have you noticed Warren Buffett has bought very few things the last 4 or 5 months, 6 months? There's a reason for it. Things are expensive. You don't get the value today when you just want to go buy something to fill a slot. That doesn't work for us. Secondly, if everything is expensive and somewhere along the line something changes about that, what this does is it gives you a buffer against something unforeseen circumstance that you didn't expect. And we feel like that's where you ought to be right now. So I want to leave you with this. This is a picture of Jay Powell with a hard hat and a shovel on the left-hand side. And so we were looking at thinking, well, I wonder if he knows something that we don't know in the coming 6 months. With that, I want to thank you for joining the call today. I hope you'll be with us the next quarter when we do it. But if you have any questions, certainly either call us or email us at oxbowadvisors.com. All the best to you. We'll see you next quarter.